Howdy, Jacob here. Today we're looking at Distribution Solutions Group in the trading companies and distributors industry. 1.7 billion market cap, 2.2 billion enterprise value. So they do have a little bit of net debt here, but their growth is out of this world. 286 million in revenue in 2014 to 1.6 billion in 2023. However, gross margin is down 60% gross margin in 2014 to 35% in 2023. Operating margin is up though, from negative to positive. They're finding ways to make some money, which is positive. But again, that gross margin hit is something that doesn't look very attractive to me. Their income statement has massive growth of cost of goods sold. So although they've increased revenue a bunch, the cost of goods sold has increased way more. Sales, general, and admin up a little bit less than revenue, so not terrible. And production of net income is very minimal margins. Balance sheet has 84 million cash on hand, 33 million short-term debt, 536 million long-term debt. Looks like they funded some acquisitions through debt, which we can see by goodwill and other intangible assets going up from about 53 million to 654 million over the last 3 years, and obviously their debt going up from 0 to 536 million. So pre-2020 and before, they were a debt-free company, 0 short-term debt, 0 long-term debt. But right now, cash flow statement does have a big jump of free cash flow. So there is a chance that this 375, they're still making some big acquisitions, but these acquisitions are beneficial in hitting that bottom line, especially the free cash flow line, which I like. But again, there's a price you pay, right? So if I pay $100 million and I only increase my free cash flow $5 million a year, that's going to be a problem. But here we see that free cash flow jumped, maybe 80 million, 70 million. So I think these were some decent purchases as long as that is right. They're still able to produce that 80 million or so in free cash flow. Their use of cash recently has looked a bit wonky because they've gone into debt quite a bit, but over 100%, well over 100% going to acquisitions, really nothing going towards anything else. They've made some share repurchases, but this 95 million huge net payment of shares, increase of shares, is dampening all of that immensely. So let's start with making some assumptions here. Again, when I make assumptions, I like to assume 100% cash flow allocation, and I'm going to have a little bit going to debt reduction because as we saw, about 536 million, so about 500 million in long-term debt, produced less than 100. So over 5 years, their free cash flow, I prefer it to be about 2 to 3 years. I prefer 0, but if they do have debt, and leveraging debt can be very efficient, if you really have great opportunities, I don't mind them using it. But when I make assumptions, I assume 100% free cash flow allocation, and I'm going to assume about 20% goes to debt reduction here. So if I assume that maybe 50 to 70% goes to acquisitions, they'll probably be able to grow quite a bit, seeing what they've done in the past. So maybe 10% or so. But it hasn't really hit that bottom line as much. And so, which we can see from gross margin being hit. And gross margin is really going to be telling you when you're an older company trying to become extremely efficient, you're very much limited by cost of goods sold. So that gross margin is very important. And so for me, I don't think it deserves quite the premium, even though they have some growth, likely above market. At the end of a 7-year period, I don't know if that'll truly be the case, and whether they'll just be making acquisitions to make acquisitions to hit that top line. But let's do a bit of a range here for margins. 3 and 5% seems fine to me. Share issuance, 1.17 million, 1%. So maybe 0.5% increase of shares based on stock-based compensation, and they stop issuing shares and issuing debt, and they focus on the money that the business brings in and allocate capital with that. That's saying the company's stock price needs to fall 60% before you get the return we're looking for here. So, I do think there's heavy growth here. even based on 50% of capital allocation going to acquisitions. But I think that their margins being hit isn't positive to me, and that I think that there's other companies better prices with that are even better businesses. So I hope you enjoy the video. Have a great rest of your day.